Hi everybody, Alex Deployer from Expert Forex, and in this video I'm going to discuss a few thoughts on account sizing for robot trading success. And account sizing is actually a major problem in robot trading. So many accounts get blown where traders are using successful robots, but their account sizing is incorrect, which makes them run out of margin and they get a margin call, although the robot itself is quite successful. And what made me think of these account sizing aspects is a recent exercise that I've been doing for the 0 to Euro robot trading course. And to give you a little bit of background, part of the course feeds settings from optimization and other areas, and only the very best settings. So there's a filtering and selection process that happens here, and it goes into a demo portfolio. So the demo portfolio only gets the very best settings, and it then trades those settings and applies more filtering to the strategies that are being traded. And if those strategies don't work, they go to what I call a hospital portfolio, and I'll talk about that a bit more. But only the very best strategies get then fed into your live portfolio. Now, in the hospital portfolio, this is where strategies that have good potential but are failing, they get sent to that area, and then there are certain tests that get applied to those strategies to see if we can improve them and rehabilitate them to go back into the demo account portfolio. So there's a lot of tricks that happen in here, and what I've been experimenting with is one of the tricks that I'm going to be talking about now, and that is account size. So here's the analysis that I did, and the analysis was actually not meant for account sizing. It was meant to test the robustness of a set of settings. So what I've done is, and this is based on an account of $20,000. So what I've done is I've taken the one set of settings, and I said, okay, if we started on the 17th of April, which is just a few days ago, and we back tested for a year, what results would we get, and what would the maximum drawdown be? And then I said, okay, let's go 2 weeks later, run those same settings for another year back and test them again. And then I went on and on for 18 weeks. So, and effectively that's well over half a year. So effectively I'm testing 18 months of period of trading, and I'm doing this every 2 weeks. So and the objective of this was to see how robust those settings were. And what happened was, as you can see, of the 18 weeks, there were 3 blown accounts. So every week we would open a new account with 20,000 and trade that. So that's why there are 18 accounts here, and 3 of those accounts got blown. But the profits that were made in the other accounts well made up for those blown accounts very easily. In fact, one of the months here made up for all of the blown accounts. And overall, the gain for over those months for that particular set of settings was over $500,000 over here. So there's a few things that we could look at here. Firstly, it shows that one set of settings could never be profitable on a continuous basis. At some stage you might blow your account, and other stages you might very small returns, and other stages you'll make massive returns, like that is a 600% return over there. So that's the one point. The other point is that the success of any strategy depends on when it gets started and when it ends, which is clearly set out here. So your starting time and date is most probably one of the most critical parts of your robot trading success. If you're unlucky to start on a day when the market goes completely mad and trends tremendously, you might blow your account if you're using the wrong type of robot. So the start date becomes a critical element, and that particular date is really based on luck. Quite honestly, you can analyze the market, you can do all kinds of things, you can select the best currency and all that, but in the end, there's no precise way to say I should be starting this robot on this particular day. So that is why we just randomly started these accounts every 2 weeks. On a Monday morning, every 2 weeks, we started these accounts. So in terms of the robustness of these settings, they're pretty robust. They only had 3 blown accounts, and the rest made up for the blown accounts quite easily. The other thing that we recorded was the maximum drawdown. Now, what was very interesting about this was that the drawdowns were quite similar from week to week. And in fact, you can see here's a period where the drawdowns were identical. And the reason why they're identical, because these are the maximum drawdown, is that over that period, the same account would have incurred or been subject to this same maximum drawdown. So there was a period where there was a really bad period here where there were 10 weeks of bad exposure to a maximum drawdown. And you can see some of the drawdowns were 28,000 and some were 15,000, but the average was 22,000. So how can we use this information to determine the account size that's required? So firstly, if you know that the maximum drawdown is 28,000, the average drawdown is 22,000, and we're using 20,000 as a starting point, you can quite safely say that if we had to increase the starting point from 20,000 to 30,000, our chances of these blown accounts might go away because the drawdown was 24, 23, 21. So we might increase our success rate to 100%, and our income might go up because instead of a minus there, we might have a plus. So we can increase income considerably by increasing our trading account balance, and by increasing the trading account balance, you also are making the trading safer because your chances of a blown account decreases tremendously. In fact, if you had to increase your account to 40,000, there's a pretty good chance you could trade for years and years and years and never have a negative month. So that is one way of finding out more or less what your trading account levels should be. There are some other factors that need to be considered besides the drawdowns. Obviously, there are margin needs, so you also need to calculate your margin needs in here. So if anything, these numbers should be slightly higher, but they give a good indication of the kind of account size you need. I would say 30,000 would most probably make 2 of the 3 go away, and 40,000 will definitely not cause any negative results here. So by using 20,000 in the account times 18, your capital that you used over the 18 months of trading, because you've basically traded that over an 18-month period, you've made 152% return because you weren't scared of blowing your account occasionally, because you knew that this particular EA, the profit retriever, would make up for those blown accounts. So there's 152. Now, if you want to be less greedy and say, I'm happy with 100% return on my money, then you would go for a 30,000 count, and there's our 540,000 investment that's required there, and then you'd still be making 100% return. And as I mentioned earlier, if you go for 40,000, then the return might go down to 70%. But 70%, let me tell you, is still a huge return on that kind of money. Now, I know these exercises get done on huge amounts, but you need to convert them to cent accounts because most of the trading at this level is done on a cent account. Now, what that means, that is, instead of having capital needs of 360,000, you can drop 2 noughts off there and you would only need capital of 3,600, and your income would naturally go down by 2 decimals, so your income will still be 5,463. So this exercise that I've done here has actually brought out quite a number of things. The robustness of this is a way of testing the robustness of settings. It's also a way of looking at the stability of drawdowns. If we have stable drawdowns like this, it's a fantastic planning tool, because you can now say, oh well, if I had a 30,000 or 40,000 account, I would never blow any of these accounts, and their incomes would essentially stay the same, because you're not changing anything in the trading activities. Now, there's a number of factors that need to be taken into account when determining your account size, but one of the things that's come out of this exercise is that account size is pretty determinable for lots of these EAs. All you have to do is do this exercise that I've just done, see what the stability is of the drawdowns, and that will give you an idea of what kind of account size that you will expose yourself to. The conclusions we've reached here is very common for the analysis that we do on other EAs, and it is quite surprising how many EAs can be made successful by just merely increasing the account size. So in other words, you're allowing the EA to trade out of a loss-making environment into a profit-making environment by providing more capital. And the profit retriever is a prime example of an EA that you can do that with. Now, I hope you found this video interesting and gave you some ideas on how you can test for the robustness of settings, but also test for how big your trading account should be and how big it should be to become risk-free. So in the description and the first comment of this video, you will find clickable links to the 0 to Hero robot trading course that I mentioned earlier, and also to the profit retriever that produces these steady results as shown on this schedule. From me, Alex Deploy, cheerio.
Yeah.